Hey traders, this is Blake Morrow with Trader Summit, and it has been a long time since I've had Mr. Dave Keller, who is also the chief market strategist at stockcharts.com and the host of the Final Bar show. Good to see you, Dave.
How are you hanging in there with these markets? Okay.
You know, it's I am personally, I am. I love the volatility. I predominantly focus mostly on currencies. So this move in interest rates that we're seeing globally has provoked a lot of volatility in the markets. But you know, I actually have to ask you that question because I'll backtrack. Like, let's say 6 months ago, when last time we spoke, you had warned us that so many stocks were trading below their 200-day moving average that we are in a in a sell rallies market, and you couldn't have been more right at the time. And the market continued to drop precipitously, but over the last couple of weeks we've seen this or maybe month and a half, we've seen this nice bounce back. So it's got to be tricky at this point, is it?
Tricky is a good word. Challenging is very much the way I would describe this market. Like, honestly, and it not that back in March or April it was easy, but it certainly felt very straightforward in terms of the weight of the evidence. You know, I see what I do as a technical analyst as looking at a bunch of evidence, gathering it all together and seeing what the weight of the evidence tells us. And I think in the first quarter going into the second quarter, you had all these clear signs of distribution, right? You talk about some of the breadth conditions, right? Stocks breaking below key moving averages and just continuing to go lower. When we got down to the low in June, it was down to single digits of stocks that were above their 50-day moving average. I think it was like 5% of the S&P. So literally almost the entire S&P index below their 50-day moving average. That shows you such a broad decline. You also had sentiment indicators that had been somewhat negative that became more and more negative as you went lower. What happened in the last 6 weeks is very different. I mean, this is a different feel in the last 6 weeks than we saw in the first 6 months of this year by far. Leadership in the growth space, things like technology and consumer ripping out of the lows. So even though a lot of these stocks are still down year to date in a pretty decent amount, they're up pretty significantly, 10, 15, 20% off of the lows, if not more. And so I think now it is a very tricky time because the question is what's next, right? The S&P's rallied up to 4,200, which was the high from earlier in June, right? High from earlier this summer. The question is, can we get above that level and hold it? This week, we're starting with renewed strength getting above there. Back in June, it was about 5% of the S&P above their 50-day moving average. Now it's about 85%, right? So 80% of the S&P have recovered to that point. So it's a much broader advance off of the lows. I think what's challenging now is separating the short-term strength from long-term recovery. And I think that's a big question mark. If you look at what's happened with the rallies off the lows, this is pretty classic for a bear market phase to see severe rallies like this. And you don't have to look that far. Look back to late March, where you saw a big rally off of the low in February. You saw a retest of the high in February, and then we rolled over. We got a couple points above there before we rolled over, and that's kind of right where we're at right at this moment. So I think there's a non-zero risk that we go and retest the lows, but I think the strength that we've seen off of the lows in June, particularly in the growth space, tells me that the market is starting to price in a recovery. And now it's about the choppiness and the volatility that will get us from here to probably a higher close at the end of the year.
You know, it will be really interesting because there's so many headwinds that the market still faces right now. And you know, we often cite the 200-day moving average, and here we are in the S&P, but maybe shy of about 100 points away from the 200-day moving average once again. How do you read, you as a technician, as a chartered market technician, how do you read the 200-day moving average, and how do you incorporate that into your trading?
Yeah, and it's interesting to note the small caps. If you look at the IWM, which is the Russell 2000 ETF, it's actually hitting the 200-day moving average this week, hitting it today as we're recording this. So some parts of the market actually already hitting that key level. The S&P is a little bit below it still, but kind of within a rounding error of it. And that's a key one, right? I think a lot of what we do as technical analysis is try to take a step back and look at the overall trend. Looking at the 200-day moving average, the slope of the 200-day, is it sloping higher or lower? Where the price is relative to the 200-day. And those sort of comparisons help you make a basic assessment about the trend, right? In general, if you own things that are above their 200-day moving average and you underweight or lean away from things that are below the 200-day, in general, over longer cycles, you're going to do really well because you're owning things that are working and you're not owning things that are not working, which is pretty straightforward, right? It's an easy, basic trend assessment. I think the other part of it is more behavioral, right? Because a lot of investors that are still bearish at this point have an eye on that 200-day moving average and say, as long as we remain below the 200-day, how good are things really getting? Yeah. If you finally recover that, if a lot of individual stocks, and it's still less than half of the S&P members are above their own 200-day moving average, so most stocks are still below theirs as well. You start to see that change. You start to see the S&P get above its 200-day. A lot of individual stocks do it as well. That's where bears no longer have a leg to stand on. And when those bears start to become more constructive, that's what adds a lot more buying power, a lot more demand. And that's where a sustainable rally can come from. The reality, though, and I think this is the challenge as we face the 200-day, a lot of times that's when people would logically put stops. That's where they would logically take profits. And so when you see the price approach the 200-day, more often than not, you expect at the very least a pretty good pullback, because a lot of people will use that as a basic assessment of trend and a basic point at which to maybe change their positioning a little bit. So the fact that we've rallied so much, a lot of technology stocks that have done so well are overbought as we're reaching these key levels of resistance, tells me it is probably a significant likelihood that we have a meaningful pullback from these current levels. And even if you're bullish over the long term, that's probably the best thing you could see right now from some of these stocks that have had a pretty good run off of the lows already.
Like as a technician, I would think that if we did have a pullback, what would make me feel really good going into the end of the year, let's say, I factor in, and I'm sure you do, seasonality into the markets. September 10th, September, October tend to be a little bit rougher times for the market anyway. But if we can actually sell off and not see new lows in some of these major indices ahead of the Santa Claus rally, does that mean anything to you? Is that kind of what you're thinking at this point?
Seasonality, I think, is a key factor in 2022. And I'm glad you brought it up. There are a couple things to think about, right? And one is we're in the second year of the 4-year cycle, right? The presidential cycle. Second year tends to be a pretty traditional year. Overall tends to be net positive, tends to be stronger, going into the summer, but then really weak going into the third quarter, beginning of the fourth quarter, and then usually a pretty good rally going into year end. If you look back at the second year of a presidential term, it's usually a pretty good rally going into the last month or two of the year. So that's something maybe to look forward to. Now, seasonally, not only are the markets tending to be weaker in September, October, but particularly technology. Technology tends to underperform in August, September, and October. And if you look at the traditional leadership out of a bear market bottom, it tends to be two sectors: consumer discretionary and technology, kind of the growthy stuff. So most bear markets have ended with leadership from those growth areas in the market. We're at a part of the calendar year where those actually tend to do pretty poor. They tend to underperform. I think that lines up with we've had a great run out of the June lows. We most likely have to retrace back a little bit. And I would probably consider that drawdown at or near the previous, the June lows, or even getting, just below current levels, probably a decent buying opportunity to play that rally going into year end.
There's many people that are citing, hey, look, the bear market's over. It's time to start buying dips again. And I think it's going to be really interesting, as you pointed out, in the second year of a 4-year cycle. Doesn't really matter who's the politician in charge. It's just more of seasonality as far as the political cycle goes. Correct?
That's exactly right. And again, the logic of it, or the justification I've heard, is it's more about where the whole policy approach and what you can do in your first year, your second year, third year, and then what you're doing in year 2 versus year 4 when you're trying to get reelected. And so that really is regardless of what party is in power, what type of administration. It's more about the political calendar and more how that tends to play out. And I think it's all about the third and going into the fourth quarter, where you could see some renewed strength based on that trend.
That's good to know. And I think it's important for people to really focus on, it doesn't really matter who's in office, because we do live in contentious times, don't we, Dave? I mean, people like to point fingers at why we're rallying, why we're selling off, but really it's more of cycles and sentiment, isn't it?
So the party in power, usually any good economic activity or market activity is because of something they've done, and any negative activity is because something someone else has done probably. And that's usually the way that they would approach it. I think you have to remember, I mean, to be honest, Blake, to take a step back, it's less about who's in power and what decisions that are being made, and more about the broader macro conditions. And my concern with this rally from where we were in June to where we are now, what really has changed? Now, some things have changed, right? Interest rates have come down. The dollar had been ripping to the upside. The dollar eased off quite a bit, which gives the space. Most of those things give space for growth stocks and kind of traditional offense to reemerge and show some renewed strength. But my question is, are we really 100% out of the woods? If you're bullish and thinking the market just goes S&P 5,000 from here, you're basically assuming that all those headwinds, which have been a huge factor in the first 6 months of the year, have evaporated or are completely gone. And I would say the Fed is still going to hike rates here probably a couple times, and that has real impact. While inflation numbers are showing some some signs of life, they're still pretty high, and inflation is still very much impacting consumers. So I think there's a reason why we'll see volatility revert back to the upside. The VIX is down to 20 and certainly could go much higher than that. It's one of the lowest levels we've seen in 2022. So I would brace yourself as an equity investor for the return of volatility, for plenty of uncertainty, but overall probably nets out to a positive outcome for stocks over the next 3 to 4 months.
All right. Well, that's good. That's good to know. I wasn't sure if you were going to, if there's anything you wanted to show, but I wanted to ask you this before we conclude. Below the surface, and I know you focus a lot on the broad markets. We've talked a lot about, what's happening in the S&P and the Russell 2000, but below the surface, what are you seeing that's percolating that could really suggest that we might have another downdraft in the markets, or that we might have a recovery? What are you seeing that's really kind of popping out at you over the last, let's just say, last week or two, especially as we stretch our legs in this rally into August?
Yeah, no, that's a really thoughtful question. And I would say the way that I would answer that is probably relating the big picture, right? We can look at the S&P and look at key levels. We can look at small caps testing resistance levels. And there's a big question mark, I think, as to whether we just blow through those. I would assume that you get some pullback from those levels. But what I like to do is then compare that to a bottom-up process. Look at hundreds, if not thousands, of individual stocks and look for patterns there. If you look for stocks making new 3-month highs, which is something I often do, look for stocks making 3-month lows. So these are stocks that, depending on what they've done, regardless of what they've done up until now, they're starting to show some strength or starting to show some new weakness. And that's an interesting way to gauge what's happening. When I ran that screen yesterday, I think I had almost 400 stocks in my US kind of large mid-cap universe making a new 3-month high. I think I had less than 20 making a new 3-month low. And that's been the case for the last couple of weeks, right? Most stocks are actually starting to show some good strength and starting to rotate. And, there are names like Apple, which have already broken above their June highs with authority, right? So while the S&P is kind of attempting to get above 4,200, Apple has already blown way past that. Microsoft showing strength. So some of those big mega cap leadership names have already driven through there. But it's not just those. Look at the charts of PayPal or Asana, even Coinbase this week, right? These are a lot of names that had resistance and now have broken above that. And that's encouraging, right? The more individual names that are participating, it tells you it's not just the mega cap kind of FANG stocks that are doing okay. It's a lot of smaller names, a lot of individual names. The concern I have, pretty much every one of those names I just shared with you is now overbought. They've had such a run that they're showing signs of extreme upward mobility. And that is good in the short term. That tells you that the trend is starting to emerge, but it also tells you that at some point, people want to take profits. If they did buy at the June lows, they're pretty happy with the gain that they've had. That usually provides a brief pullback, and it could end up being a decent buying opportunity in the next month or two. But I think a pullback is pretty likely. So the individual stocks, I think, line up with that short-term weak, long-term strong kind of thesis that's starting to emerge.
Okay, well that's good to know. But I'm gonna ask you one last question before I let you go. What is there anything out there that keeps you up at night? Like you look around, you're like, man, this is just not sitting well with me in the markets right now.
So I would say absolutely, and I think there's plenty. From a non-technical perspective, I think the prospects of inflation and what the Fed has telegraphed that they're going to do, and then they certainly are planning to do, is a challenge, right? I could not I don't think you can look at the evidence and look at everything that we're seeing and assume that's done, that the negative impact of higher rates and higher inflation are over. I don't think that the Fed is that on top of things just yet. That's a concern for me. From a technical perspective, think of sentiment as a pendulum. And we went to a very bearish place in June, which was, sentiment at completely bombed out levels. The AAII survey and everything very, very negative, sort of a capitulation of sorts. But now all of a sudden the pendulum swung back. And if you're really bulled up right at this moment, you're assuming that the pendulum came right back to zero and stopped, and that's not going any further. What you have to remember is the pendulum swings both ways, right? And it can also go to an overheated condition, and that's what concerns me. The unbridled optimism I'm seeing on Twitter and social media telling me that everything's great, that doesn't make me feel good. I'd rather be buying when people are not excited about the markets, right? The famous quote from Walter Deemer is, when the time comes to buy, you won't want to. And I still see way too many people super eager to be buying and assuming that everything, all the negativity is behind us. I don't think that's the case. And when people recognize that, that's when the market can get really painful really quickly.
All right. Well, Dave, I love your work. I always appreciate your work, and I appreciate the way that you explain your charts and the environment. So as a trader, how do I follow your work closer?
Yeah, I appreciate it, Blake. It's awesome, as always, to talk with you. Stockcharts.com is the main place where we do our work. And again, it's focusing on empowering investors to use technical analysis to make better decisions. We find a lot of amateurish approaches to technical analysis. We really try to teach you the best practices. John Murphy, Martin Pring, and others really demonstrating, and myself and others trying to demonstrate the best practices of technical analysis. My own website's called marketmisbehavior.com, and I have a YouTube channel and other places where I share a lot of best, ways to apply technical analysis to the current market environment.
All right, Dave. Well, I do appreciate your time. And I know those traders from Trader Summit, our community, they're looking at you right now. And I'm going to suggest that they give you a thumbs up if they're watching you on YouTube. Subscribe to the channel so they don't miss any of this content. We need to meet quicker and more often than just every 6 months. So I promise that's my fault, and I will correct that. But thank you for spending your time with us and blessing our community with your presence today.
I appreciate it. Thanks for what you're doing, Blake, and thanks for having me on.
All right. We'll talk to you soon.
Bye-bye now.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.